time gap is important because if you can match the inflows and outflows, you don't have to borrow from outside. We can relate this to our personal life as well. For example, at the end of every month, we receive our salary, but we actually spend from the salary throughout the entire month. So if we do not match the timing, if we cannot match the timing, there will be a lot of time where we need to borrow from outside. We need to borrow from other people. So we must make sure that our inflows and outflow timing is matched. Now the challenge is it's not very easy. It's not very easy because inflows and outflows come from different companies. Your inflows come from receivables. Your outflows are due to payables or salaries or accruals. So there are different type of individuals you are working with. Some of them your employees, the outflows are your employees, outflows are your banks, and your inflows your inflows are basically your customers. So there are different types of individual, different types of companies we are dealing with. So matching your timing may not be entirely easy. You need to have a lot of years of experience, relationship, client relationship to deal with this timing. And over the years, when you have this standard set, then you can inform your customers, your clients that this is the way you work, and they have to follow your guideline on timing in order to help you or you help that company. So matching of timing is the first job. Second is match the size of the inflows and size of the outflows. It would be really easy for you. It would be really easy for you to manage your working capital, manage your company, manage your family, manage your budget, your pocket, your wallet, whatever you want to say, if you can match the size of inflow and outflow. For example, if you have $300 of income per week, okay, per week. So this is your income plus figure. Now, if you can manage the size with your outflow, for example, your outflow is, for example, $270 per week. So if you can match these two figures, it would be easy for you to manage your budget. You will be able to know how much money you have, for in your pocket for the next month. And then the first objective was you need to make sure that this 300 comes first, then this 270. Because if your timing is mismatched, meaning that your plus is coming later, your negative figures are due earlier, meaning that you are in trouble. So what most of the time, I think this example is very relevant to us. You know, when you start your job, your first job, when you start your first job, you basically don't have any money in your pocket. So the first month is very crucial. That is the month in many companies they give you some loans for you to buy the necessaries and buy the basic necessities that you can do. And at the end of the month, when you get the salary, you pay the company, you pay the person you have taken the loan from. Maybe you have taken the loan from your friends and family. So this is where the matching principle comes in, synchronization comes in. So our first job as the finance manager is to make sure that our inflows and outflows are matching in terms of size and in terms of time. Now the next is, aside to synchronization, as I said, synchronization is very tough. It's really, really tough. You need to have strong relationship with your clients and your customers. And then over the time of 10 to 15 years of working with one client, you'll be able to gradually minimize the timing issue and the size issue. But it takes a lot of time. But first of all, we try to do synchronization. If synchronization is not possible, then you go to acceleration of cash receipt. We must make sure that our cash is coming faster. Now, there are a number of ways that companies make sure that their cash is coming faster. The first and foremost, which is not written here, the first and foremost is making sure that all of your customers are paying in cash. Okay, we must make sure that all our customers are paying in cash. These are the three For example, lockbox, pre-authorized debit, and concentration. These also deal with cash, but these have an assumption that most of our sales are accounts receivable. That means our cash will be coming a bit late. But obviously, the gold standard is to make sure that all your customers pay in cash. That's the reason why when you do shopping, when you do shopping, let's say in big shopping malls sometime, especially in Asia, in Malaysia, I have seen it, in Brunei, I have seen it. What they do is when you use credit cards, they charge you 2% extra. When you use credit cards, they charge you 2% extra. They say, oh, this is my cost and everything, my operating cost and everything. That's not actually the case. The case is they are actually encouraging you to use cash. Previously, and even in big markets, McDonald's, KFCs, and big chains like that, they always take cards. If you go to Walmart and others, they take cards, credit cards and debit cards. But in Asian context, I have seen in many supermarkets, they generally discourage use of credit cards. That means they basically encourage you or kind of force you to use cash. So this is an initiative by companies to accelerate their cash collection. They will try to collect the cash as earlier as possible, or they will use at least the debit card. Debit card is equivalent to cash. The reason why companies encourage the use of hard cash, because when you pay the company using card, company, let's say McDonald's, you went to McDonald's and you have paid using card, any card, debit card or credit card. What McDonald's have to do is they will collect all the collections, all the receipts, and they will submit to the bank. So this will take some time for the bank to clear and transfer the amount that you have spent in McDonald's to McDonald's account. So this 3-4 days time which is taken, it's sometimes the company doesn't want to wait. So they want to accelerate the cash collection. Therefore, sometime when you are going into a shop, on the door it's written we only accept cash, or they will be writing like sorry, we don't accept cards. The reason is actually financial. Sometimes you may see, oh, why they are writing it, this is inconvenient. It's actually financially convenient for the firm. Now you understand why they are writing that they only accept cash, because it's a gold standard. When you collect cash, money comes in first, you are cash king, like the Malaysian Prime Minister, they used to say, cash is king. So really cash is king. With the moment you have cash, you have the flexibility to spend, and you have the power. Now, if you don't have cash, let's say you do receivables or you do other forms of collection, how do you collect? First one, in the US, there are a lot of log box or locker box, they call it locker box. Now, what is the purpose of locker box? Is to collect checks. I'm not sure whether you have seen a check because the after the electronic payment and bank transfer and the app related transactions started, I think the use of checks are now very limited to very posh class of customers or for large amount of transfer, I think. So there used to be a time when there was a traveler's check. I'm not sure whether any of you are aware of it. The American Express traveler's check was really, really popular, and it was equivalent to cash. So when you are going to another country, you don't have to carry any cash. You can just carry traveler's check. So a check is a financial instrument popularly used by banks, because bank has the only capacity, only bank can clear a check. No other financial authority, no other financial authority or institution like insurance company, leasing company, no one can clear check. Only commercial bank can clear a check. So you will have, even though you are transacting, for example, for an insurance company, paying your car insurance using a check, it will be still a check of BIBD or Baiduri or some bank, because only bank can clear a check. So anybody who can write a check, or any company that can give you a checkbook, is basically a commercial bank by definition. So these checks, mailing these checks sometimes is very difficult task. When the customer wants to pay you, they will pay you using check. That's fine. We accept check. But this check will take some time. They call it mail delay. Mail delay means basically it's the delay, it's the time gap from the customer paying you with the check and the check received by the company. So let's say you have customer in Kuala Belait and they will pay you using check. So what will happen? You will have to collect the check first from Kuala Belait, and the check will come to the central bank in BSB. Let's say within the day it will be coming, and the next day it will be represented to the central bank for clearing. There is a specific check clearing unit with the central bank. So it takes around 2 to 3 days time, and the maximum time is check delay, check in transit. They call it check in transit, meaning that the check is still coming. So now Brunei is a relatively smaller country. Now, if you're thinking about US, for example, with the check culture coming up, in the US, there will be you'll be having customer, for example, in Alaska. You'll be having customers in different parts of United States. So you need to have a special arrangement to reduce the delay of transit. So what you do is in specific locations where you have maximum of your customers, you will establish lockbox. Now, lockbox can be independent initiative. In the US, I even saw that in important roads, at the corner of the road, they will have checkbox. So you can put the check into that box, and later a check collector will come, open the box, and collect the check for your company. So there will be another initiative where different institutions, or they call it kiosk. Nowadays, they call it collection kiosk. Now, in the kiosk, what you can do is just go to that office and put your check into that kiosk, and check will be collected by someone and posted for you as a customer. So there will be boxes, locker box, secured locker box for you to deposit your check. Those will be collected by the company people in order to process the check so that they can collect the cash faster. So this is the procedure to fasten your cash collection. Now, still, it will be processed, it will be cleared through the central bank. It will take some time, but the company is still having some initiative to collect the check faster. Second one is pre-authorized debit system. It is a system where the customer will give an authorization to the bank that every month a specific amount of money will be deducted from your account for certain payments. For example, in Brunei, my several payments are pre-authorized. For example, my car payment every month is pre-authorized with a Baiduri account. So every month certain amount of money will be automatically deducted. So what happens is the collecting company, let's say your company has sold some product and the customer is using pre-authorized debit, the collecting company does not have to bother much. Automatically, at the end of the month or at a specific time period, bank will automatically deposit the money into your account. So pre-authorized debit system is a very convenient system for companies. They prefer or they encourage their customer to pre-authorize the payment with the bank so that receivable collection is faster, cash collection is faster. Pre-authorized debit system is on the rise because it's secured and it's bank-to-bank transfer, it's account-to-account transfer. It happens quickly, very, very efficiently, and often it does not involve currency exchange and other things. So you don't have to also involve additional people to clear check or reporting checks or do additional posting for other activities. So companies prefer pre-authorized debit system. Second one is concentration banking. Concentration banking is actually a theoretical concept, but it has practical essence. The companies, those are having customers in different parts of the country, they actually have satellite accounts connected to a master account. Let's say you have customers in 4 states of Brunei. So what you do is you will have satellite accounts. You have smaller accounts in 4 different states connected to a master account in BSB. So every time there is a collection happening, all the satellite account collections will be automatically transferred to the master account. So at the end of the day, they call it EDP. Let me write it for you. EDP. In banking language, they call it EDP. EDP is end of day processing. End of day processing. So for every master account, every day they will create a EDP. This EDP report is generally forwarded to the company so that the company can look into their update in the satellite account and master account and can make necessary adjustment with the customer. So a concentration banking is basically connected accounts. It's a connected accounts of smaller branches for the ease of collection from the customers, and then it is connected to a master account. It's a bigger account in the central region somewhere in the headquarter, so that you can see at the end of the day how much money is coming in, so that you can also talk to your customer why the payment has not been made, why there is a delay in payment, and also you can thank the customer those are paying on time. So these are some of the ways we can make our collection faster, make our cash collection faster. Let's look into now the second aspect of cash control, disbursement control or payment control. Now the slash, after the slash it's written delaying in payment. Now it's kind of awkward to look at it. We normally cannot or do not want to delay payment. Delaying payment generally is connected to your credit worthiness. If you are delaying payments consistently, customers will not be able to do business with you. The company will not do business with you because you have a tendency or attitude towards defaulting. So generally the concept is that delaying payment, meaning that you're basically controlling your disbursement. So all the payments that you have to carefully monitor them. You have to carefully control them. So in order to control your payments, you need to have a system that can track the payments. In order to control your payments, what you have to do is you have to track your payments. You have to make sure that you have control on your payments. And then in the recent time, we use technology. We use a lot of technology in order to track our payments. And these technologies are connected to banking services. They connect the banking services to your company in order to help you to track your payments. Now, there are two very traditional services that we use. First one is similar to concentration banking. We call it payables concentration. Payable concentration is when you have payment to make in satellite accounts. Let's say you have client. You have client that you have purchased raw materials. They have an account in Kuala Belait. That's a satellite account. So from your master account, from your main account in BSB, Baiduri Bank, for example, we pay the customer in the satellite accounts. And at the end of the day, all the satellite account payments will be reported back to the master account for an update. So through the EDP, bank will let you know that this is the total amount of payment that you have to make tomorrow, and you must have sufficient amount of money available in the satellite account. That's the way you try to coordinate between all the payments done from all the accounts. Now, the other account that you can carry with the bank is a zero balance account. Zero balance account is a special facility provided by the bank. Nowadays, I heard that it's very common, especially for trading purposes. ZBA, they call it zero balance account, is an account where amounts are transferred only when there is a real payment. So let's say you have satellite accounts. Remember, you have a client in Kuala Belait. So you need to pay, let's say, $2,000 to that customer, right? So this is for this you have given a check to the customer. So what the customer did, the customer will present this $2,000 check to the Kuala Belait branch. Okay, they will present the KB branch with a $2,000 check. Immediately, when the check is submitted to the satellite account, the master account, let's say in BSB, the master account AMA in BSB will transfer the money to KB branch and settle the payment. Okay, so when the check is presented by a client, immediately the master account will transfer this $2,000 to KB branch to settle the deal, settle the payment. Now, once the payment is settled, $2,000 is paid. The satellite account in KB, after this payment, will have a balance of again zero. So you are not basically wasting any money for the KB branch. The satellite account will be only used when you are going to pay any client. So this zero balance account makes sure that it ensures that you have zero unused amount in any account in any parts of the country. So at the end of the day, again, all amount will be transferred back to the master account so that you can make proper planning of how to use the master account balance. So these two traditional, very traditional way of managing your payments. And this will give you some account of how much money you have, how to use the money, and also will help you to match your payment, match your size, and match your timing so that you can proper money for payment to your clients. And no customers are unhappy because you are paying on time, because the satellite account will give you a clear identification of how much money you have to pay to whom. And immediately after the payment, the account will be again kept zero balance. One of the easy ways to manage timing of the cash flow is by creating a cash budget. Now, you have done cash budget before, I'm sure, in some accounting classes, but I will go through at least one example and I will try to upload another example for you. I think I have uploaded 2 examples already. I'll try to show you the result of one example just to get some view of it, how it is done. What is a cash budget? It's a snapshot of fund management in the short run. So it's basically a snapshot of cash management in the short period of time. So this snapshot here is Q1, Q2, Q3. You can do it for monthly basis. Large companies can even do cash budget for weekly basis. So it's a time period of distribution of cash inflows and outflows over time, so that you understand how much money you have to pay in which quarter or which time period. The objective is to find the deficit and surplus. So the objective of a cash budget is to find how much is the deficit and how much is the surplus for a specific time period. So if you have surplus, then you know that from this quarter you have some surplus money which you can invest, and from certain quarters you may have deficit which you can manage to collect fund from other sources to pay. Based on the estimation, new funds can be sourced or extra fund can be invested whenever is needed. So I'll give you an example now, just to roughly go through the example and see how a cash budget works. Let me open this for you. Okay, I think these are the 2 cash budget examples I have already uploaded. One is a global SDN BHD, and the other one is, I think, Delete SDN BHD. These are both Malaysian companies. Examples are given for as mini cases. I have just changed some of the figures for you to look at it from a different perspective. So the smaller one is Delete. So let me do the Delete one, and I will upload the solution for both so that you can go through the global SD and PhD. So let me read it briefly, see how it goes. Delete SDM BHD purchases raw materials on credit. The company wants to plan for short-term financing so that the management can forecast future need of capital. The sales for January to May 2017 are given here in million Malaysian ringgit, respectively. The sales are all on credit. Delete maintains a 230 N90 credit policy. This is very important for you to understand what is the credit policy of this company. And with the suppliers and debtors, the credit purchase is 75% of the current month's sales. Payment on credit purchase is usually made at the beginning of the next month. So if you purchase anything on credit, you will make the payment at the beginning of the next month, and you will earn 2% discount. If you're paying on time, you will get the 2% discount. An average aging schedule of the company shows that the customers pay, your customers pay on the average 30% of the current month's sales, 40% of the previous month's sales, 30% on the second last month's sales. So out of your 100%, your customers will pay you 30% on the current month, 40% from the previous month, and 30% from the second last month. The first 30% payment by the customers within the month of the first month payment, usually considered a 2% discount. Wages are 20% of the sales. Wages means the salaries that you pay to your employees. Monthly rent for your facilities, your factories would be 6 million. You have tax payments to make, and this is due in May. The company will pay Malaysian ringgit 12 million to buy a new machine in May. So there will be some cash outflows. Interest payments are expected to be Malaysian ringgit 3 million. This will be paid in March, April, May, respectively. Delete is expected to carry a beginning cash balance of Malaysian ringgit 20 million in March. So that means even though it is expected that the information is given from January, but since the beginning cash balance is given from March, meaning that your cash budget should start from March. Its target cash balance is estimated to be Malaysian 8 million. Target cash balance means this is the minimum cash balance that you should carry every month. If you have a cash balance below 8 million, it means you are in deficit. This target cash balance is decided based on company's average payment. Let's say in the past, the company has seen that their average payment per month is around 8 million. So they will carry this estimated cash in order to be prepared for any future payment. What is asked from you: prepare a cash budget for this company, estimate the surplus and deficit of funds for March. You see, March is the beginning period. For March, April, and May, for these 3 months, it's basically 1 quarter. So they are asking you to prepare for March, April, and May 2017. If the company does not want to raise external funds, discuss the strategies to manage the deficit of funds. So let's look into it, the cash budget, how they prepared it. Let me take you to a solution. Okay, this solution file I will upload later. Just be careful what you have to do. It's an Excel in short. So just double click this Excel file, this table, double click it. It will open the Excel file. So in the Excel file, you will have both. Look at the bottom here. You have global SD and BSD, and you have delete in 2 different sheets. So we are currently dealing with delete. So let's go to delete SD and BSD. And you can see the policy is that they have 2% discount for 30 days, and the net amount due is in 90 days. So for the receivables, their customers must pay within 90 days. If they pay within 30 days, you will give 2% discount. You will also receive 2% discount from the customer as well. The months are given: January, February, March, April, May, and we have to prepare the cash budget for March to May. And these are the credit sales given. I'm not exactly sure whether the figures are same. You check it later. I'll just show you the process, how the process is done. So the credit sales is 200, 250, 180, 30, and 100. These are basically credit sales given, should be given. Otherwise, you have no information. And the 75% of these credit sales are credit purchase. The information should be given. So 75% of the credit sales are credit purchases. So we have calculated 75% of it. If I double click, you know, you can see that 0.75 multiplied by C8. So it's 0.75 is 75%. Now we need to go to receipt and payments. In the receipts, you have current month's revenue. You will get revenue from, remember, 30% from the current months, 40% from the last month, and 30% from the second last month. So from March, you will get 30%. So let me show it to you. So 30%, 0.3 is the 30%, and 0.98, 98% is basically for the discount. So you will receive after discount, after 2% discount. So you will not receive 100% of it. You will basically receive 98% of that 30%. So from 180, this is the amount. I'm not sure exactly whether the amount is correct. You'll do it later and check whether it is correct or not. And then you will receive on previous months. You'll receive on previous months revenue. There are 2 figures. You can, let me click it for you. There are two figures here. One is 40%, one is 30%. Okay. So in the next month, in April, you will have 30% on April sales, and you will have 40% and 30% from March and February sales. Let me click it, and you can see from March and from February, you have additional sales. Okay. Now in May, from $100, you'll have 30%, and this remaining 106 will be from April 40% and March 30%. So altogether, these are your net revenue. And remember, on every first month, 30%, you have to deduct 2% for discount. So you will have extra 2%. So I think I made a mistake somewhere, or intentional mistake. I want you to find out the problem in the receipt part. So find out the problem. What is the problem with this one? Let me identify the problem area for you. When you go through this Excel, there might be, I'm not telling you exactly where is the problem, there might be a problem with this line. So 52.92, 38.22, and 29.40, there might be a problem with this line. So find out the problem, what is the problem can be, and check the other example as well when you are checking other example. When you are checking both the examples, look for credit sales as well, see where the credit sales are correctly done, and then check the current month's cash payment, see whether the receivables are correctly noted or not. Okay, let's assume that these are correctly done and you have net revenue of this amount, just the total of these two figures, and you get total of 212.92, 185.22, and 135.40. Let us now go for the payments, cash outflow. In the cash outflow, we have payments in the following month. Remember, the payments would be made in the following month. So each payment will be made in the next month. So let me show it to you how it is calculated. So this is basically C9 multiplied by 0.98, meaning that if you pay in the next month, you'll get 2% discount. So you will pay only 98%. So if you pay 98%, this figure is coming from where? It is coming from this 150. After discount is 147. 187.5 after discount is 183. 135 is 132. 97.50 is 95.55. So after discount, these are the figures. Again, check whether the figures are correctly calculated. Wages according to the percentage given, rent according to the percentage and month, taxes to be paid only in May. So it only appears in May. Interest payment, you pay interest payment $3 million each month. Investments, new investment of $12 million. They want to buy a machine or something in May. And the net payments calculated, just the total of all these figures calculated. So you have 228, 167.3, and 148.55. These are the figures that you have as total payment. So you have total receipt and you have total payments. Now the next job is quite easy for you, that we need to take the net cash flow. What is the net cash flow? Is the difference between two. So 212 and 228, your payment is high, so you have a negative value of 15.83. Second one, you have 185 plus, you have 167 minus, you have plus 17.92. The last one is 135 plus, you have 148.55 minus, you have 13.15 minus. Now, beginning cash balance is in March. Remember, in March, you have 20 beginning cash balance. So this beginning cash balance is 20 here. So ending cash balance is the adjustment of beginning cash balance and the net cash flow. So if you look at it, let me erase it so that I can show it to you clearly. So look at it, you have a minus figure here, and you have a plus figure, beginning cash balance 20. So the result would be plus figure is higher. So you have a plus 4.17. Now this 4.17 would be basically your beginning cash balance for the next month. Now in the next month, you have 17.92 plus and plus 4.7 total 22.09. This 22.09 would be beginning cash balance in the next month. In the next month, you have 13.5 and then 22.09 plus. So you have an ending balance of 8.94 positive figure. And every month you need to have a target cash balance. Remember, target cash balance of $8 million. So after adjusting for the $8 million, how much you have now? In the first month, you supposed to have 8 million, but you actually have 4.17. So actually you have a deficit of 3.83. In the second month, you should have minimum $8 million. You have actually 22.09. So you actually have 14.09. In the last month, you must have $8.88 million. You actually have 8.94. So you have 0.94 of balance. Now, let me warn you here. Some companies, and it is kind of like nowadays a practice. What they will do is they will adjust this target cash balance with the beginning and ending cash balance altogether. So what they will do here is they will add the ending cash balance and the target cash balance together, or they will kind of like consider target cash balance as the payment needed, is the amount needed. So if it is the amount needed, it's a negative figure. So they will combine it with the total cash balance and calculate the figure from the very beginning. But the usual practice that we do normally in textbook is we first adjust the beginning and ending cash balance, then we adjust the target cash balance, the way it is shown here. Now, after the adjustment of the target cash balance, now you see how much is your deficit. Surplus and deficit is 3.83, 14.09, and 0.94. This is the amount that you must have. This is the amount that you have surplus or in deficit. If it is a negative figure, it's a deficit. You have, for example, in the first month, you have $3.83 million of deficit. In the second month, you have 14.09, and in the third month, you have 0.94. Now, it's good that you still have good amount of money as surplus, so that you can actually pay from this surplus whenever any deficit comes in. But some companies, they may have consistent deficit amount for which they need to go to a bank to finance. What you can do, how deficit and surpluses should be treated: collect deficit from deducting following year's surplus. So you can basically carry forward. You can have a short or temporary arrangement with your customer that can we settle this 3.83 in the next month. So if you just carry forward 1 month, you'll be able to solve this deficit problem. Okay, also how you can reduce the deficit issue. There is a massive investment. Where is the amount? Let me show you the amount. Okay, $12 million of negative figure of investment. So you may also consider moving this investment to some other time so that you can manage the deficit in that month. Because of this $12 million, actually your surplus drops to only 0.94 from 14.09. So you may want to move this investment to some other month in order to retain a healthy surplus. Also, whenever you have a surplus amount, your objective is to make sure that the surplus is going into the new machinery. So you have 14.09. You may decide to invest this into buying the machinery, but you may still want to consider to move this investment of $12 million to some other month, so that you do not want to take any risk. You do not want to take any risk. You don't want to go to the bank right now. So this investment can be done in the next month as well. You just have a sufficient amount of good reserve right now, and then you do the investment. What are the other things that you can do? You may want to reduce credit sales and increase cash sales. Remember, I told you this is the gold standard. In order to increase your cash collection, the first thing you do is increase the cash collection. Then raise funds from short-term bank loans. You may do not have any other choice than to go for a short-term bank loan, and this bank loan will help you to solve your deficit problem. Defer taxes. There is a possibility that you may want to pay your taxes later. So this is called defer taxes. Deferred tax is a legal issue. It's not illegal. You can legally do it so that you can settle it with the government that you are going to pay your taxes in a later date. Investment, that $12 million, you can do the investment later as well, some other time, and you can do some estimation as well whether this investment is really needed right now. But remember, this investment is connected to sales, so if you don't do the investment in the current period, you may have your sales going down in the next period. So you have to be very careful when you do the estimation of this investment. This investment again is connected to capital budgeting decision. Remember, we have done capital budgeting decision in your financial management, I think. So it's connected to NPV, payback period, and other things. So you need to analyze it properly before you take the investment decision. And also cutting cost in order to get thin and lean and thin, they call it. You need to reduce some cost, possibly need to look into unnecessary costs that the company is paying so that you can cut some costs. And when you cut the cost, your inflows will generally increase, not at the same rate as before, but it will give you some surplus fund. And the company may prefer also to use internal cash. Company may not want to go outside to the bank to take bank loan. So if the company wants to use internal cash, you want to utilize your surplus, you may want to move very carefully with your monthly plan. So our objective is to make sure that the company has sufficient surplus and company can disbursements. If the company see that there are too much of deficit coming up, they may want to shift their investment to other months. They want to increase cash sales. They can have an agreement with their clients that these 2 months we are in some shortage, so can you pay us in cash instead of receivables? They can also do some tax planning with the government. Instead of paying in this month, you can defer your tax payments in order to reduce your cash deficit. So this is the way we do cash management. I will upload these two solutions for you. Once again, try to be very careful when you go through these figures, see whether there's any problem or mistake done. If there's any mistake done, let me know. I will update the revised version. Okay, next thing would be okay. These are the two examples I have uploaded already. I will upload the solution later. Okay, now is the second aspect of short-term asset management is inventory management. Now, inventory has three stages, as you possibly know. These are the most simplest example of inventories. First one is the raw materials. Second goes to the work in progress, and then goes to finished goods. And these three processes can be time varying for different companies. Raw materials processing may take much longer for Boeing compared to other companies. So different type of companies take different amount of time for processing their inventories. So inventories would be management of raw materials, working process, and finished goods. Inventory is expensive in terms of carrying. When you want to carry inventory, hold inventory, it's very expensive. You have to carry it in your warehouse. Warehouse is expensive. Ordering new goods may also take time. So when you're ordering for new raw materials, it may take some time. You may not get it instantly. For example, now during this pandemic time also, when you order for things, it comes really late because the supply of things are limited. Therefore, there has to be a balance between how to carry or how much to carry and how to instantly order. So you need to make a balance between how much you can carry and how much you can order. So let's talk about groceries that you have at home. Let's say in my house, when I have grocery now, I can only go out and do shopping from Huaho or other places maybe once in a month or once in a week. So I have to make sure that the grocery that I have can sufficiently run for 1 week before I can go out and shop again. So this is where you can make a balance between how much you can carry, because when you carry, there will be spillage, there will be wastage, And so what is the expected amount of time? Let's say 1 week. The existing purchase may not go 1 week because of some problem. So you need to make sure how much you need to carry, how you need to carry those inventory, and when you need to order again so that your inventory comes on time and you can start working again. Okay, so what is your objective is to reduce total inventory cost and to clear the stocks, sell the stocks to retail store as fast as possible. So your objective is to make sure that your products are sold quickly so that those are going out of your receivable list, your inventory is being cleared as well. And you also make sure that when you are carrying the inventory and ordering from the inventory, this inventory cost is the lowest. Remember, you need, when you are carrying your or holding your groceries, you need a fridge, you need a lot of other costing for making sure that inventory is carried properly. You have groceries carried properly. So think about a company that is purchasing raw materials, and that raw materials has to be kept in a warehouse. That warehouse has to be properly sealed. There has to be insurance for that. There has to be security guard carrying, the security aspect of the inventory. So there are a lot of cost involved. And because of those costs, we need to make sure that the inventory cost is the least and we can clear the stock as soon as possible. Two major inventory costs: inventory carrying cost, when you are carrying inventory, cost to hold inventory with the company. So there is warehouse cost, there are other costs involved with carrying. The other one is the inventory ordering cost. When you are ordering for inventory, you have to wait for the inventory to come. There is transportation cost, there are cost of ordering itself, there are email cost, messaging cost, and the human cost as well. There'll be somebody who is in charge of inventory ordering, you have to pay them. You have to manage the sample, in order to purchase inventory, the company will send you samples, and this sample exchange cost, a lot of cost involved with ordering as well. So there are inventory carrying cost, inventory ordering cost. Your job is to make sure that inventory cost total is least. How to manage inventory? We'll give you an example of inventory cost in the next slide. So let's talk about how to manage inventory. Managing inventory follows different techniques in different countries, and there are a lot of new methods being introduced in the recent days. Most of these are technology intensive inventory management system. Theoretically, there are two uh, theoretically, there are at least one. The first one is theoretical, just-in-time method is preferably used or coined by the Japanese. The Americans use just-in-case. So the Japanese, who use just-in-time, they believe that their transportation system is very quick and fast and efficient, so that whenever you order for inventory, it will come to your factory or your location on time. So it's very good for the digital era. It's the drone era coming up. So whenever you're ordering from things, and drone can supply you with whatever raw materials you are applying for or trying to buy. But just in time may not be possible, where you have transportation delay, where you have inefficient system. The payment system is not fast, so you may not have this convenience of just in time in those countries. There are a lot of developing countries where just in time is simply a nightmare. You don't want to think about just in time in those countries. So Japan might be a good example. Some European countries might be a good example of just in time. Singapore can be a good example of just in time. Australia can be a good example of just in time. So these are considered to be developed countries. When you go to developing world, it's really tough to order things and get those things on time. Red line method, it's a very what do you call it, it's a very raw, crude method of looking into your inventories. Red line methods are generally used for smaller inventories. Let's say you have 1 million pieces of nuts and bolts. Let me repeat, let's say you have 1 million pieces of nuts and bolts. These are very small pieces. So it's not possible for you to count them every day and find out how many pieces are remaining. So what you can do is you will put them into a big jar, and you put a red line at the bottom somewhere of the jar. So if your inventory comes below this red line, you will order again. So that's called a red line method. I have seen similar thing for Horlicks. I think you know what is Horlicks. It's kind of, what do you call it? It's a hybrid mixture energy drink for kids, I guess. I don't know whether there's anything energy in there. It's garbage these days. I was talking to my wife the other day, and she said the Horlicks doesn't have the same taste, and it's basically tastes like malts, something similar to Milo. So Horlicks, they used to have for their big jar, big bottles. They used to have a yellow line. I saw that a yellow line in the bottom of the bottle. It shows that this is the reorder point, meaning that when your Horlicks reaches this point, you need to order for a Horlicks because it may take one day for you to go to the shop and buy. In that one day, you can finish the remaining portion. So as long as the that reorder point is identified, you'll be able to understand when to order for inventory. You can manage your inventory properly. So that's a red line method. Now, for the sake of color, it can be yellow line method, it can be green line method, as long as you can identify with certain color or certain identification that this is the reorder point. Now, typically in the textbook example, they call it red line method. The most recent and the most popular method nowadays is computerized techniques. So there are a lot of computerized, computer-centric, technology-centric methods that they use, including barcode POS, point of sale system, available in most shops these days. So say, for example, if you go to McDonald's, they will sell things to you, and they have a screen in front of the person who is serving you, and on the screen they basically take your order, and as long as the order is done, it automatically adjusts with all the raw materials that they have. It's funny though, sometimes I really kind of like confused when when you go to McDonald's and when you order for something, and that lady in the counter still have to tell you that, can you please wait for a while, let me check inside whether the burger is available. So that's really creepy, because the technology that she has in front of her, the screen, must show which item is in shortage. There has to be a red line somewhere, there has to be a flashing light that we are running very low on potatoes, so it is the time to order for potatoes. So that's the benefit of having a computerized system, because when you are scanning some customers buying 120 kilos of potato, you are running low on potatoes. So that is the potato thing that you have to order for your company to purchase. So when you are ordering things in McDonald's and the lady is telling you that, sir, please wait, let me check whether we have sufficient quantity of, for example, bubur ayam. Most of the time it happens with me. So I don't know why this happens, because this computer is supposed to give that lady quickly an indication of which item is running low and which one is not. If this is not giving an indication, that means this computerized system is incomplete. Somewhere there is a problem. So barcode scanning system should help you, the point of sale system should help you instantly adjust your inventories, and possibly even put an order to your supplier that we are running low on potato or running low on chicken. So they will be able to send you the items that you need. So computerized technique would be very efficient, and it requires less human cost, and it can sometimes make the decision on its own. You just have to set some algorithm or levels or limits. So that's a very convenient system, but you have to buy the system, you have to buy computer, you have to buy the software, rent the software so that you can use computerized techniques. The other management of inventory would be through outsourcing. Many companies do not want to hold inventories at all. They will give it to some other companies because they believe that holding inventory is costly. So Coca-Cola they used to engage other firms to manufacture bottles, long time ago. So their bottles used to come from other farms, and when the bottles reaches their factory, they will just fill it up with the syrup and fill up the trucks to bring those to the customers. But nowadays, Coca-Cola found that this bottling plant was giving them a lot of trouble because of supply and supply shortage or problems with the supplying farms. So Coca-Cola decided to take the entire supply chain in their own hands. So they now manufacture their bottles and the bottles come to it's actually the same assembly system. It's the same assembly system that manufactured the bottle. The bottle goes into the syrup section, fill it up with Coca-Cola that you see, the black color one, and then eventually packed into cases, then filled into the truck. The truck carry all the Coca-Cola bottles to the shop. It's one assembly system that reduce costs and all other uncertainties that Coca-Cola used to have. So outsourcing can be one of the management ways, one of the strategies that you can go for in order to manage your inventory. By outsourcing, you basically do not carry any inventory at all. Your inventory is managed by somebody else. So outsourcing definitely has positive and negative sides because you're paying a lot of money to outside companies to manage your own inventories. And those companies, those are managing your inventories, may not entirely understand your practices. So you have to kind of like incur a lot of costs to educate that company how they should move on into managing your inventory. So there might be some issues with them as well. So these are the four methods that we usually see in large companies or small companies managing inventories in different countries. There might be new ways coming up. You can read them, inventory management systems in different companies, and can get some ideas as well. Okay, so let's go into the calculation part. Our job is to make sure that the total inventory cost TIC is the lowest. It's calculated, divided into ordering cost and carrying cost. The ordering cost is calculated by T divided by Q multiplied by O. I will explain this. And the carrying cost is C into PP multiplied by Q divided by 2. Now here Q is the quantity. Q is the quantity to order. C is the carrying cost, PP is the purchase price. Generally, C into PP is represented in one shot. And T is the total demand in a year. How much is your total demand? How much you are ordering? And how much is the carrying cost? How much is the ordering cost? O is the ordering cost per unit. O is the ordering cost per unit. So when you have all these figures, you'll be able to calculate how this go on. So with these examples given here, what are the information given here for you? Total demand for this company is 180,000. The ordering cost per unit per order is $50. That means every time you order, you will have to incur $50. C into PP is basically your carrying cost in percentage, represented in dollar is $2. So your carrying cost per unit is $2. And you have order cost of $50 per order, and total demand for the year is 180,000. Now using this, you can calculate for each quantity. Now let me show the quantities for you. This is basically in this line you're showing the cost, and here you show the quantities: 2,000, 4,000 quantity, 6,000 quantity, 8,000 quantity, and like this. So for each of these quantity, you can see for 2,000 quantity, you can calculate what is the cost, what is the inventory carrying cost, what is the inventory ordering cost, and things like that. Say, for example, if I show you an example here, insert text box. Just to give you an example, I will upload the solution of this later, so don't worry about it. So let's say you have quantity of 2,000. Now what does it mean? This means that in this order, the order that you are making, you are basically ordering for 2,000 units. Now what you need to see is, with this order, how much is your ordering cost and how much is your carrying cost. Now in order to get the ordering cost, you need to have 180,000. This is your demand, divided by the quantity, which is 2,000. Okay, multiplied by the ordering cost of 50. So if you do this, you'll get the ordering cost. Now what happens to your carrying cost? Now let me write it for you: total ordering cost. TOC. What happens to your carrying cost for these 2000 units? Total carrying cost, TCC, would be C into PP. C into PP is given already, $2. So you have $2 multiplied by, you have Q divided by 2. Q is quantity, 2000 divided by 2. This is your total carrying cost. Now, there is something that you need to understand here. Your total demand in a year, total demand 180,000 is fixed. Let me repeat, total demand 180,000 is fixed. The only thing that can change, even the ordering cost is fixed, carrying cost is fixed. The only thing that can change, that only thing that is variable, is the order quantity. How much you are ordering in each order, how many quantity you are ordering in each order is the only variable item. So you can order 2000 unit, you can order 4000 unit, you can order 6000, 8000, 10,000, 12,000, even more or less. Now, if you order more, you have to understand this. If you order more, okay, more than 2000, let's say you are ordering 10,000. So when you are ordering 2000, 180,000 divided by 2000, okay, how many orders you are making? You are making 90 orders. Let me repeat. When you order 2000 quantity in each order, let's say you are ordering for bread, you have to have 180,000 breads. Now, in each order, you are ordering 2000 breads, meaning that you have to have at least 90 orders in a year because your total demand is fixed. Now, let's say you are ordering 10,000 in each order, and you still have to reach the same amount, 180,000. How many orders you have to make? So we take out 4 figures. It's basically 18, right? One is 90, the other one is 80. So if you order more quantity, if your quantity goes up, your number of order drops. That you have to understand. If your order number drops, your quantity must be high. If this is the case, then the relationship between ordering cost and carrying cost is opposite. Okay, now how it is opposite? Let's say when you order 18, if you're ordering 18 orders, okay, you are ordering less. Previously, you ordered 2 to 180,000, meaning that almost 5 times high. So 90 orders. When you order more, your ordering cost goes up. Okay, so your ordering cost will go up if you're ordering more. 90, 100 times, 200 times, 300 times you are ordering. Every time you order, $50 will be fixed ordering cost. So more order, more ordering cost. But more order means less quantity. Always remember, more order means less quantity. So if you order more, okay, your carrying cost would be less. It would be opposite. So if you have carrying problem, let's say your warehouse is small, you do not have proper facilities, you don't have a fridge. Remember, relate it to your personal life. If you have a smaller fridge, you will not buy 10 kilo of chicken every week. So what you will do? You will buy smaller amount. You will go every day, buy 1 kilo of chicken because your fridge is small. So if your carrying capacity, is smaller, you will order more. But that ordering more is going to increase your ordering cost, meaning that every day you have to go to Waho, every day you have to buy petrol, every day you have to have other costs. Every time I go to Waho, I sit in the restaurant and eat. So there are a lot of outside expenditure that you have. So company also, when they are ordering more, there will be a lot of cost involved, ordering cost and plus others. But why company order more? Because they have limited carrying capacity. So ordering, number of order and quantity ordered oppositely connected. Therefore, you see it's shown in the line here. When your ordering quantity is increasing, ordering quantity from 2000 to 10,000, when it is increasing, okay, when it is increasing, one cost is increasing, the carrying cost will increase. Which one is the carrying cost? This one is the carrying cost. 2,000, 3,000, 6,000, something like this, 8,000, 10,000. Okay, because you are carrying more quantity. But at the same time, when you are ordering more quantity, your ordering cost is dropping. 4,500, 3,000, 2,250, 1,500, 1,125, and 900. These are basically reducing because your ordering number of order is low. When you order more quantity, you order less time. So your ordering cost goes down, your carrying cost goes up. So what is the total cost? When you add the total cost, this will be 6,500, 6,000, 6,250, 7,500, 9,125, and 10,500. So ordering cost, total ordering cost comes down to this level. The lowest ordering cost, sorry, lowest total cost is here. This is the point where you have the lowest total cost. You see this line, the lowest cost is here. 6,000 is the lowest and the ordering quantity is here. So around 3,000 quantity, you have the lowest total cost of inventory, which is $6,000. Now this is the point that you need to identify. This is the ordering quantity at which you have the lowest inventory cost. This point is called, in the next slide, we call it EOQ, economic order quantity. This is the quantity, economic order quantity. This is the order quantity, 6,000 unit, at which we have the total inventory cost to be the lowest, the least inventory cost. How it is calculated? You can use one equation, 2 into O ordering cost into total demand divided by C into PP. So 2, $50, 180,000, and 2 is the C into PP. We have 3,000 quantity. That quantity, if you order, your total cost would be the lowest. Your inventory cost and carrying cost would be the lowest. Now, EOQ is what managers want to achieve. Remember, our objective is to reduce the cost. So we want to achieve this, but achieving this will not be very easy, because when you want to achieve ordering quantity, economic order quantity, it goes through a lot of assumptions. You need to have good transportation system. You need to have things coming to your raw materials section very quickly. You do not have any labor unrest. Your labors are working fine. So all these conditions, when they are working properly and perfectly, then you can have EOQ. EOQ is strongly connected to just-in-time method. So meaning that your all other system must be efficient in order to have the EOQ working. EOQ is also very beneficial for the firm. If EOQ is maintained, cash requirement for business will be lesser, meaning that you don't need to waste your cash. You don't need to unnecessarily keep cash for inventory management. So cost will be reduced as well. Your cash requirement will be lower as well, because you don't need to keep cash for the inventory monitoring purposes. You don't need to hold inventory unnecessarily. You don't need to order for more inventories unnecessarily. So every company wants to reach EOQ, economic order quantity. This is the quantity at which the total inventory cost is the lowest. The last part, let's finish it, then we will go for a break. Credit management. Accounts receivable is the last of our short-term asset management. Accounts receivable is when you are selling things on credit. So these are basically your customers will pay you after some time period, and you need to manage it properly, because if you don't collect your cash from accounts receivable, your entire company will be in trouble. The key to accounts receivable management is relationship. You need to establish a trusting relationship with your client, with your customer over the years, so that your customer understands your cash need and pay you on time. Now, effective credit management or accounts receivable management, it's similar to a loan. Remember, credit means you are selling something on credit, meaning that you are not charging the company at the time of the sale. You are giving some time period for them to pay you after 40, 30, 90 days time period. So this is similar to a loan. Instead of paying with cash, you go for a loan, meaning that you are allowed by the bank to wait for some time to pay for the purchase. So credit management and a loan management is similar. So when you are managing your credit, basically you have to have, first thing, you have to have a proper credit policy. You need to have a written credit policy. You need to write it down somewhere that this is your policy and signed by the customer and you, so that both parties respect the credit terms. What are the things that you need to have in credit policy? There are at least three items. First one is credit standard. You need to establish what are the qualifications that the customer needs to have in order to get a credit from you. Remember, credit is similar to loan. So if you go for a loan with a bank, you may not get loan because you do not meet the requirement. You may not meet the qualification standard. So for a company also, when they're selling on credit, they must maintain a minimum standard, minimum quality, so that they can decide which one is good credit and which one is not. So any company coming to you for credit, you will check whether they are qualified or not. How you normally check? You do ratio analysis of that company. You do performance analysis of that company. So after doing ratio analysis on liquidity, profitability, and other aspects, you can decide whether that company applying for credit from you, whether they're qualified or not. Second thing is credit terms. You need to establish when the credit standard is met, then you sit with the client and you decide the credit terms, such as 210 net 30, meaning that if the customer pay within 10 days, you will give them 2% discount, but the net payment period is 30 days, meaning that the customer must pay within 30 days. If they are not paying within 30 days, that credit is considered as bad credit. Last one is collection policy. You also need to clearly identify how the cash will be collected, whether cash will be collected using cash, whether it will be collected using check form or pre-authorized debit system or bank transfer. So how you'll be collecting it, who will be collecting it, whether the sales personnel will be collecting, whether the managers will be responsible to collect the cash from the client. You need to clearly identify them. Receivables monitoring should be updated with the collection policy. Company should continuously talk to large customers for faster collection without jeopardizing the credit worthiness. So you need to talk to the large customers. Those have a massive amount of fund due with you. You need to have a close relationship with them to make sure that you can collect your cash faster. Why you need to collect your credit faster? Because there is a cost of credit. A firm that buys on credit is in effect borrowing from its supplier. So when you are selling on credit, you are creating an account receivable for you. You're actually giving a loan to another company. So that loan can have a cost. It has an effective annual rate. Remember, we have calculated effective annual rate. I suppose that you know it, effective annual rate, how to calculate it. The equation is given here. So we can calculate what is the effective annual rate of $100 accounts receivable with this term, 210 net 30. So if the company is allowing 2% discount on 10 days, but the net payment period of 30 days, the effective annual rate is 44.6%. My goodness, in a year, 44.6% in a year. Meaning that, let's say, if you are the company taking accounts receivable, let me repeat, you are the company, you are taking the chance of accounts receivable from another company. So you have purchased on credit. You have purchased on credit. So when you purchase on credit, $100, the company promised you that if you pay within 10 days, they will give you 2% discount, but you have to pay within 30 days. So using this equation, they have calculated that if you take the discount of 2% for 10 days, this is not actually 2% per se, This is 44.6% per year basis. That's a massive, massive amount. So instead of 44.6% deposit discount with this company, if you instead go for a loan to pay cash to this company, you can now compare this 44.6% with the cost of loan. Let's say a cost of loan is what, 16 to 70% per year. This is the effective annual rate of a cost of loan. So where is 44.6 and where is 16%? If you go for a bank loan to pay for the same raw materials, the bank loan costs you 16%, and you can pay the company using cash from the bank loan. But if you go for a credit with the same company, and if you take the discount, the opportunity benefit that you receive is 44.6%. So if you lose this discount, in other words, if you lose the discount of 2%, if you lose the discount of 2%, you basically lose 44.6% of benefit, meaning that your cost of this accounts receivable or cost of this account payable that you have to pay is 44.6% compared to only 16% of bank loan. So this cost is really, really high for a company that cannot take the advantage of discount. On the other hand, if you are giving the loan, meaning that you are the company that is allowing the accounts receivable, you are giving loans to other company, you are selling things on credit, and if you are giving 2% discount to that company, your client, when you give 2% discount, you are basically sacrificing 44.6% in a year. That's a massive, massive cost. And then when the customer cannot even pay within 30 days, your cost is even higher. So that's why accounts receivable is very, very important. When you allow somebody to buy on credit from you, you are sacrificing a massive amount of opportunity benefit. 44.6%, almost 50% in a year you are sacrificing. So you have to make sure your receivables are really good quality receivable and these are coming on time. There is a way to monitor them. We can create an aging schedule. Aging means based on time period. Aging schedule for your receivables. Microsoft did it for 2003. Let me show it to you. The age of the accounts, 0 to 5 days, 6 to 30 days, 31 to 60 days, 61 to 90 days, and 90 plus days. These are basically the time period within which your accounts receivable is due. So what is the accounts receivable due for 0 to 5 days? Net amount 590 million. This is what is the percentage of accounts receivable? 11%. How do you calculate this 11%? 590 divided by 5196. What is the average number of days this receivable is due? 4 days. Now, similarly, you can prepare for the rest of the table. For example, if I take another figure, 90 plus days, 302 million due. This is 6% of the total receivable, and this has been due on the average for 102 days. Now we can multiply this percentage with the average number of days to calculate something called DSO. DSO is days sales outstanding. This is basically your receivable turnover period. Receivable turnover period is the number of days your receivable is outstanding. Receivable is yet to be collected. So if you multiply them, 11% with 4 days, 19% with 25 days, 54 with 42%, 42% is 54, then 22 with 87. If you do this, you get 108.21 days, meaning that for Microsoft, on the average, their receivables are due for 108.21 days. Now they can now compare with other firms. They can compare with other year. For example, they can compare with 2002, 2004, and then can make a decision whether their DSO is longer or not. If the DSO is long, it's bad for the company, meaning that your accounts receivable is outstanding for a long period of time. So your objective is to make sure that you have this DSO as short as possible. Okay, so this is the way we monitor our receivable. Now each of these, you can see which one is the highest here. say for example, this is the highest amount, 42%, due for 54 days. Okay, this is amount wise also the highest, is 2180, in terms of millions, almost $2 billion is due for 54 days, which is 42% of the total receivable. So what you can do is talk to this customer as frequently as possible and make sure that they are paying on time. You can also talk to the other group, 61 to 90 days, give them some discount, extra benefits, take the CEOs and other people to lunch, dinner, and make them understand that the amount paid is possible. The extra discount or something, you can collect this money as soon as possible, and you would be able to reduce these 108.2 days to a lower period. If you can make it low, it would be good for the company. Okay, we have only 3 slides remaining, but we need to refresh ourselves. So we'll come back after the break. Today we'll take a shorter break. We'll come back at 10 o'clock. This is 9:40 now. We'll come back at 10 o'clock. We need to finish this chapter, then move to another chapter and do something with that as well. Okay, then we'll when we come back, we'll talk about the remaining part, the liability side, how the liability side contribute to the working capital management. See you at 10 o'clock.